Let's take a look at Chapter 4 now. Go into the assignments and the study plan. And so we'll break out Chapter 4 for a minute. Prepare an accounting worksheet. Alright, so let's look at Section 1 for just a minute. Which part of the accounting cycle provides information to help a business decide whether to expand its operations? Well, post-closing trial balance, closing entries, and adjusting entries are all a part of the accounting process. But if I'm an investor, if I'm management, I want to work off of the financial statements to make any decisions. So it's going to be D, financial statements. Which columns of the accounting worksheet show unadjusted amounts? The income statement and balance sheet columns are at the very end, so they've already been adjusted. The adjustments are in the second set of columns, and the ones that start off as unadjusted are simply labeled as trial balance. Okay, let's talk about supplies. Supplies has a $3,000 unadjusted balance on your trial balance. At year end, you count supplies of $1,000. Okay, so we have $3,000, which is an asset that's what's sitting on the books right now. At the year end, we only have $1,000 left, but we don't have any expenses shown. We have $3,000 on the books, so we have to get it down to the right amount. Well, supplies is an asset, so to reduce it, you're going to credit it. In this case, it goes from $3,000 to $1,000, which is a $2,000 difference. So you're going to decrease the asset supplies by $2,000. And what happened to those supplies? Well, you used them up, so you're going to expense them. So the $2,000 is going to be debited to supplies expense and credited to supplies. Alright, let's look at this list of accounts real quick. We've got accounts receivable, and they want to know what a normal balance in each account is. Okay, so accounts receivable is the amount the business expects to collect in cash from services that they've already done. Okay, supplies. Now, supplies is basically what we would call a prepaid expense. We know we're going to use them up, but we don't know when we're going to use them up. So we record them in an asset. So let's see which one matches this. The cost of the supplies on hand for use would be what the supplies are. Prepaid rent is another example of a prepaid expense. So it's going to be an asset also. Amount of rent that was prepaid and is available for use by the business. Okay, what about furniture? The furniture account actually holds the original cost in it. So the cost of furniture purchased for use is actually going to be the answer there. Accumulated depreciation furniture is going to be in a contra asset account, which means that it's right after furniture on the trial balance and on the chart of accounts. It's basically an offsetting account for furniture. As we use up or depreciate furniture based on whatever estimates we use, then this contra account will increase, and it has a credit balance, so it's offsetting the balance of furniture, and the original cost stays in the furniture account. You don't adjust the original cost. So it is the portion of the furniture's cost that has depreciated. Alright, F, accounts payable. Accounts payable means things that I owe people, so the amount that the businesses owes creditors. Unearned service revenue. Now, service revenue may confuse you. It's not a revenue account. Anything that is unearned means you have not earned it, so it is a liability. It means you've received something, but you haven't done anything yet. You record unearned service revenue when somebody pays you in advance of the work that you're going to do, but you haven't done it yet. So it's actually a liability until you do the work. It's the amount that the business has collected in advance from customers and owes them in the form of service. Okay, service revenue, the amount that the business actually earned during the period. And rent expense is the actual rent that was used up during the period. The used up portion of prepaid rent. The cost of obtaining a place to do business. If you didn't have prepaid rent, your monthly rent would be what? That would be the amount you have for rent expense. Let's look through a couple of these problems and see if we need anything here. Well, here's what a worksheet looks like. Notice how the trial balance has those, and then we have the adjustments column. All right. Let's see what we have here. We got 4 adjustments, A, B, C, and D. Every adjustment has, just like a because we have adjusting entries, a journal entry has to have what? It has to have 2 pieces. It has to have a debit and a credit, and the accounts that go with them. So each of these should have 2, a debit, one on the debit side and one on the credit side, and then they should balance out. Okay, so let's move that there. The adjusting data is accrued service revenue of $2,900. Accrued service revenue means revenue we have earned but not collected. That would mean accounts receivable and service revenue. We haven't recorded it yet. So we've actually earned it, but we haven't recorded. So A is going to go to accounts receivable. We're going to debit it for $2,900. We're going to credit service revenue. I was a little early to do my checks here. So we have to do all 4 first. Supplies used in operations. Well, that has to do with the supplies account and the supplies expense. Okay, we have supplies used in operations was $600. So they're giving you the amount of the expense. It doesn't say how much is left. It says how much was used. We know that this was $1,300, but how much was used? They said $600. So we're going to credit supplies, B, with $600. Now with the debit side of that, we have to go to supplies expense. So B, $600. Accrued salary expense means salaries that are earned by employees but we have not yet paid. The difference when you collect your check and when you actually get paid for. So most people do not get paid for the same week that they work. They're kept a week or 2 out on their paychecks. So the expense, we're going to accrue debit salary expense because we haven't recorded it yet, and we're not paying cash. That's one thing to remember with all adjustments. None of these will affect cash. No adjusting entry will ever affect cash. It has to do with timing differences between the cash basis and the accrual basis. That's why we do adjustments. So the other part of C, if I've got $1,200 on this side, then it had to go to the liability for salaries, $1,200. All right. Depreciation expense, $3,900. Well, depreciation expense is always going to be, you're going to debit an expense and credit the contra asset account accumulated depreciation. You do not credit the equipment account. You always credit you have to keep the original cost in there. The accumulated depreciation, because it is an estimate, is the only account that you use on this one. So, depreciation expense, $3,900. And accumulated depreciation, $3,900. And I gotta get my little letter there, I forget that. One last piece. I didn't total it. Got 4 entries, let's total those up. Let's pull the calculator up. You guys haven't used this before. Okay, so I got 2,900 plus 1,200 plus 3,900 plus 600. 8,600 in the debit column. Yeah. On the credit column, we got 600, 3,900 plus 1,200 plus 2,900. 8,600. So the two columns are in balance, so I am good to go. Alright, the adjusted trial balance is simply where if an amount doesn't have anything in the adjustment column, we bring it over directly as it is. If it has an adjustment, we have to adjust for it. Okay, so in the first instance here, we've got, I'm done with the entries here. We've got cash. There's nothing that happened to it, so we just bring the 13,300 over to the adjusted trial balance. Accounts receivable went from 0 to 2,900 debit, so we're going to put 2,900 here. Supplies, it had a 1,300 debit and a 600 credit. Well, the debits are greater, right? We have to subtract because they're on opposite sides, the debit and credit. So 1,300 minus the 600 is going to be 700. We got $700 worth of supplies left. Nothing happens to equipment, so we just bring it over. Accumulated depreciation, it's a credit. It gets 3,900 on the credit side, so we're going to add both of those. They're on the same side. So 18,500 and 3,900. And then you can bring it, if you notice that, you can bring it right down to wherever you're with this arrow key. If you haven't done that before, you can bring it down, right down like that. Alright, so let's clear that out. So 22,400. The credit, accounts payable 2,900 and no adjustments, so 2,900. And then salary payable goes from 0 to 1,200. Common stock was no adjustments, so 2,300 here. Retained earnings, bring it over. Service revenue, we have 89,100 plus 2,900, 92,000. Okay, salary expense, we have 42,600 plus 1,200, so 43,800. So let's put that down there on the debit side. Depreciation 0 and a 3,900 debit will be a 3,900 debit. Supplies expense 0 and a 600 debit will be a $600 debit. Alright, so let's total this. And then that'll be the last thing we can do before for part 1 here. Let's add these together. 13,300, 2,900, 700 plus 66,600 plus 43,800 plus 3,900. Oops, lost my focus here. Counted that twice. I don't think it did. Alright, so I lost my train of thought here. The bad thing about these, it takes a while and you make a mistake, you gotta go back and redo it. 13,300 plus 2,900 plus 700 plus 66,600 plus 43. $43,800 plus 3,900 plus the 600. 131,800. Bring that down there. Okay, so now we have to check this side. 22,400 plus 2,900 plus 1,200 plus 11,000 plus 2,300 plus 92,000. 131,800. They are in balance, and everything works out. Now, the first 6 sets of columns are like that.